Hey guys, Jeb here, back today talking about capital gains and real estate. It's something that often comes up when talking to people about selling property, and today I want to answer a couple of the common questions that do come up in these conversations. Before I get into it though, if you'll do me a favor, if you're watching these videos, give me a like, subscribe, comment. Tell me more of what you want to see, because I'm happy to do more videos and put them out there for you. So, and then I'll also start by saying, clearly, I'm not an accountant, not a CPA. This is my understanding of capital gains taxes. But if you are selling a property and you have tax questions, you should clearly contact somebody that has a degree in that and can help you get through that process. So anyway, with regards to capital gains, so capital gains in real estate are essentially the difference from what you purchased your price for and what you sold it for. So an example would be you bought a property for $500,000, you sell it for $750,000. So the difference there is $250,000. So that $250,000 is essentially your capital gains. Now, in the state of California, you can be exempt from capital gains for a couple of reasons, right? So if you are married, you get a $500,000 exemption on capital gains if you have lived in the property 2 of the last 5 years. So it doesn't have to be consecutive, but 2 of the last 5. So an example there would be you bought your property for $500,000, you sold it for $1 million. There's $500,000 in gains there. If you are married, in theory, that $500,000 is non-taxable. You can go and use that money for whatever you want. Now, say in the same scenario, you bought your property for $500,000, you sell it for $1 million, and you're single. So now you've got $500,000 in potential gains on that property. Now, as a single person in the state of California, you get a $250,000 exemption. So that $500,000 minus $250,000, you're still left with $250,000 of potential taxable income. So some things to keep in mind here: if you've done any improvements to the property, any real estate commissions you pay as part of the transaction, those all come off of that capital gains as well. So I'm giving you a lot of examples, but I feel like it's easier to explain it that way. So if we go back and we say, you bought the property for $500,000, you sold it for $1 million, there's $500,000 in taxable gains, and you're a single person, you subtract that $250,000, so you've got $250,000 in taxable gains. Well, let's say on that property you did a $150,000 remodel, and you spent $50,000 towards real estate commissions in selling that property. So that's an additional $200,000 there. So out of that $250,000 that's left, you can essentially subtract the amount of money that you put into the property for the remodel, and you can subtract the real estate commission. So then in that case, you're only left with $50,000 in taxable gains. So there are, and you've got to have receipts, or you're supposed to have receipts in order to document any of the remodel costs that you put into the property, etc. And those are questions clearly for an accountant and somebody that can really help guide you through that process. I'm more here to kind of give you examples of what real estate capital gains are, and what you would be responsible to pay if you were in that situation. So it's a cool deal if you can get around it. Now keep in mind, if you have an investment property, and you sell that property, then the capital gains, it's got to be a primary residence. I didn't mention that initially, but it's only on a primary residence, and you can only do it every, I believe, 2 years. So if you've got multiple properties that you can't do them all at the same time, even if you've lived in them 2 of the last 5 years. So keep that in mind. And then as for investment properties, the capital gains is a little bit different. So when you go to sell an investment property and you have capital gains, there's something called a 1031 tax exchange that allows you to take that taxable gain and roll it into a like property, an investment property, a more expensive like property, if you will, and avoid any taxes on those capital gains. So there are ways around capital gains on investment properties as well, and I'll probably do a video to talk about 1031 tax exchanges, because that's a popular subject, especially with investors. So I hope that's helpful with regards to capital gains on primary residences. in the state of California with regards to real estate. But again, if you do have questions, please comment below, send me an email, contact me directly. Would love the opportunity to help. Appreciate you taking the time to watch. Talk again soon. Bye-bye.